me now is Russell Investments Chief Market Strategist Stephen Wood joining the conversation. Stephen, it's good to see you.
Thanks for having me.
Thanks so much for joining us. So we got the jobs number, and it's the end of the first quarter.
Correct.
Now, on Thursday. So how was the first quarter from your
We think it's going to be that 1 to 1.5% GDP growth rate, so kind of right down center pin.
Low.
Not recessionary. Not great growth either, so it's kind of chugging along probably for this year at about 2%, which is right down that average rate of growth, like a CC minus economy.
How about earnings? Because Kevin says corporate earnings are really the telltale sign that you have to watch, and then we'll start getting first quarter earnings in about 2 weeks.
Yeah, I think so. Earnings are going to be negative. The question is at -2, -3, -4. I think you were saying -7, which might be a little low, but we'd be in that negative single digits for this quarter. Earnings recession, but then again, I think, to give the other side of the equation, a lot of the earnings hits are coming in energy space and in oil, and we're beginning to see the front end of that wave where low energy prices are beginning to help. So I think that could offset some of the more negative assessments as consumers have more money in their pocket. Gas is more like $1.80 to $2 a gallon. So we're in the front end of that wave.
What's the best place for investors to position themselves? Because we've seen oil drag down the markets. We've seen a lot of volatility, even going back to last August where we were down 10%, then we're up 10%, then it happened again this year too. So how do investors position for that type of volatility and this earnings recession that we're talking about?
It's really interesting. If we just said to people a little bit older, if oil prices...
Why are you looking at me for? What's that all about?
Come on, Maria.
That oil prices being so low would be a negative. That would have seemed kind of crazy a generation ago. And that correlation or the relationship between oil up, the market up, the oil down, we're going to see that break down a little bit, we think. But I think if you look into the false choice that a lot of Americans look at is if we have a neutral and negative view on U.S. equities, and we do, that doesn't mean you can only go into cash. So you can look at a globally diversified portfolio. We think European equities, they're a lot cheaper. They're beginning their economic cycle. The European Central Bank's really revving the engine over there. Japan would be a distant second. So we like risk assets, but we think you need to have a global and a multi-asset strategy.
Even with the negative rates that you're seeing overseas, where the global central banks are taking the rates into negative territory.
Rates are negative in Japan.
How do you think that will affect the investment there?
But it's also precisely because of that. I mean, financials aside, when I look at Europe, and I was there last week, I was in Spain, I'll be back in France in a couple of weeks, it is the issues that they have in Europe which cause the European Central Bank to get very, very aggressive. So in 25 or 50 years, I don't know how the euro is going to unfold, what's going to happen in Japan in the next 25 or 50 years. But because they need to really print a lot of euros and yen to deal with those problems in the next 25 or 50 months, for example, investors can really make a risk-adjusted return. So I think one needs to look at it from the medicine that's being provided can be an opportunity in the near term.
But with Europe, what you've seen in France and in Belgium, how does that not impact and make your outlook more negative with these terror attacks, with these nations that are going to have to spend more money on intelligence and law enforcement, which is not necessarily stimulative to the economy, and find an American who wants to go on vacation in Europe, which is a critical part of their economy?
It's a great question.
Yeah,
Can you strip away the reality of what's going on in Europe?
Right.
Yeah, those are fantastic questions. And what I would do is I'd look at, whether that's, in 2007 in Britain, the Madrid bombings before in the United States. We've seen that the terror attacks, as horrific and sad as they are, they tend not to have lasting market-based consequences. So I would go back to the fundamentals. I'd look at corporate earnings, economic cycle, look at where the central banks are, which I think would put Europe in a little bit better position.
Yeah, and I think to hit on Dagan's question, I mean, these are large global multinational corporations. Look at Siemens. The European Central Bank is going out and buying Siemens debt. It's actually had negative yields. That's impressive for a big multinational corporation. They're comparative to GE. They have a 4% dividend yield. So in the Europe story, when we're talking about investing on these global names, it's an acronym called TINA. There is no other alternative, right? So they have to get into risky assets. Yeah, they have to get into risky assets like stocks.
Yeah, that's a great point.
Buying energy credit. In fact, can you imagine if the Federal Reserve started buying investment grade credit, which
and this is very, very interesting. And we find out how deep, how broad, how liquid U.S. markets really are, and the European markets are not. So the European Central Bank really needs to go and create the markets to have the securities that they can purchase in a QE. So there are opportunities in fixed and in debt and in equity space, but also to euro that's more like 110 and not 163 or 170. If you're a German exporter, pharmaceutical, automotive, this cheaper euro, cheaper yen, there are pockets of opportunity that exists. You just got to be nimble, you got to be global, and you got to do your research.
All right, interesting stuff by Europe and Japan. Stephen, good to see you.
Thank you.
Thank you so much. Stephen Wood joining us there. Next.